All right. Good afternoon, traders. And to some of you, good afternoon again. Welcome out to the Tradespoon Active Investor Workshop Series. I always look forward to these. We get to do them every other week. A little bit of an educational component to what we do. Today, we're going to be talking about trading in an earnings cycle. So, basically trading during earnings season. Of course, companies are constantly reporting earnings, but we tend to see a huge surge, 70 to 80% ish are reporting around the same 2 week, 2 to 3 week, mostly 2 week window. And that's what we're going to talk about. What do we do going into it? What do we do holding through it? What do we do after it? What should we be thinking about? What kind of characteristics will be exhibited, and how do we then build strategies accordingly? I don't have specific slides. We're winging it a little bit today, so it's just going to be more of a discussion. Have questions ready to ask, and I will try to answer them. We'll bring up some charts. We'll talk about some things. Hello again to you, Phil. Thank you as always. And hello again, Faust. Yeah, definitely participate. If you've ever wondered, hey, what should I be doing during earnings? Earnings are tough. One of the reasons I do like trading certain ETFs is I don't have to worry about earnings. I don't have that quarterly hiccup where I have to adapt and adjust what it is that I'm doing and think about where am I? How close to earnings am I? Yeah, et cetera, et cetera. So my name is Scott Beck. For those of you who don't know me, I am the head trading coach here at Tradespoon. I will be lucky enough to hang out with you for the next little bit as we discuss trading in an earnings cycle. I do, as a introduction, want to let you know a little bit about myself. I have been trading for over 20 years. I started off working on a trading desk way back when. It actually was technically the late 90s. And stocks were still trading in fractions, and I had a little bit less gray hair and other other things. I have been coaching, mentoring, teaching for the last about 18 years. That's me. Faust says, never again trading before earnings. See Amazon, safer to trade after. Okay, yes. Yeah, we actually did one. It was a very controlled trade, but we did one on AMD, and we got the side 100% wrong. Right? We got out. I was able to get out, not lose everything. I was willing to lose everything. It was a speculative trade, so I will speculate on earnings. There's different things we can do at different times. That's exactly what we want to talk about. I need to remind you, as always, that trading in options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks. We won't accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results. Should be considered. Lastly, I and or the team of Tradespoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block of FINRA and SIPC member broker dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. What strategy? What was my AMD strategy? We bought speculative puts, right? With some of the news and some of the things happening around the chip sector with their ability to get back from disruptions in the supply chain, etc. I bought some out of the money puts. The next day, it opened up, it sold off, then it started to turn around. I got out. I probably took a 60%, 70% loss, and it just smashed higher, even today, higher. So Okay. So let's get some charts up. Let's talk about earnings season. So first of all, identifying when are we in an earnings cycle. I've changed up a little bit how I do this. I used to use Alcoa AA, Dow Component Aluminum Stock. You will notice that on my platform page right here, you can kind of see the earnings. You can see another one here. I leave my charts with some extra space out here on the hard right edge so that these can be floating and I can say, oh, look, there's earnings. So that's the first thing I'm going to tell you about today's presentation. Number one, know when earnings season is. You can use Alcoa. It's not like Alcoa is wrong. It's just that the financials kind of jumped it. So this was on the 15th. So at this point, we're really getting to the tail end of earnings season, right? This is really the last week before it slows down considerably. If I go look at Goldman Sachs or JP Morgan, you'll notice that earnings popped a little to the left. So it used to be that AA was first, but now you can actually see a number of financial companies, as I rattle through some of these, are a little bit before, a day or two before. So if you want to use the financial companies, JP Morgan, Goldman Sachs, Bank of America, whatever, any of those, that's usually going to be the starting point of when earnings kicks into gear. That's number one. So always know when the overall earnings starts. Number two, always, no, I can't tell you how many times through the years. So I told you I've been coaching for more than 18 years. I would say that I have worked with at least 10 to 12,000 traders over that time in various formats. If there's something that's happened in trading and education and working with someone, I've seen it, dealt with it. There are some things that I see over and over and over, and one of them is earnings, and one of them is not knowing and then being caught off guard. Like you don't know, all of a sudden you're looking at it after hours, it's down 5-6%. You're like, what the hell's going on? And then you're like, oh, earnings. Okay, if it's on your watch list, know when the earnings are, right? So that's the next key takeaway from today's presentation. Know when earnings season is in order to know what's going to happen. Not know what's going to happen with earnings, what's likely to happen as we watch, coming in. Know when the earnings is for your individual stocks. I'm trying to see. Let's see here. Let's look at maybe Thursday. Who do we have on Thursday? Moderna, Penn National Gaming, Regeneron, Duke Energy. Okay, so there's still quite a few reporting. So if I erase my lines, and again, feel free to comment, ask questions. Let's take a look at Moderna so we can see what does it look like coming into it. So here you can see this has been down here floating since 3 weeks ago as this has moved closer and closer and closer and closer. Right now, what am I expecting? I'm expecting as we get close to earnings, a couple of things. Now, price, it can be iffy, right? You'll notice last year before earnings, it went down. This year before earnings, it seems to be going up. What do I tend to see though? 7 to 10 days before earnings, maybe a little bit more, but you tend to see an implied volatility swell, right? So volatility ramps up, then the earnings are announced, and then that volatility drops off pretty hard and fast. This is what's known as a volatility crush. If you've ever heard the term volatility crush, you're like, what do you mean? I mean, maybe a volatility pop, like it's a balloon, is a better visual representations. But as we get closer to earnings, the market makers are pumping that balloon up, up, up. And then once the announcement happens, remember that implied volatility is representative of expectations. Of course, expectations are increasing before earnings. We know that there's high likelihoods of gaps and big price moves based on a violent reaction if there is a positive or a negative surprise. So those expectations cause options traders, right? You got bulls who are like, oh, it's going to be great, and they buy calls. And as they buy calls, what do the market makers do? They raise the price of the calls. And you have people who are like, oh, I'm nervous for my stock. I'm buying puts. I think it's going to be bad, like I did with IMD, buying some puts. As we're all buying puts, what's happening? Market makers are pumping value in, pump, 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 and it's pumping up. Now, there's no more expectations once the event happens. That's like placing a bet after the sporting event, right? There's no more expectations. Now it's just reality. What happened? So what happens to the volatility? It pops, it crushes. So the volatility you're going to find typically is increasing on the way up and then dropping dramatically on the way down. So you can see it happen right there. Boom, boom, right? And again, is it every single time? No. Is it a high enough correlation that you're like, yeah, okay, Scott, I see the pattern you're talking about. So what does that mean? That means if I'm going to trade in this window before earnings, my expectation is that implied volatility will at the very least stay high or will increase. So what kind of strategy will I implement? Well, if volatility is going to go up and I want to benefit from volatility going up, I need a Vega positive strategy. Vega positive. So if you don't know what Vega is, I'm going to explain it real quickly. And again, the door is open for you to ask questions. So it's gone a little quiet. I don't know if I've explained this, but when it goes quiet, my assumption is that A, you're just enthralled with the beauty of the presentation. You're like, oh my gosh, I had no idea that earnings information could be this interesting, Scott. And that B, you think that I am a handsome and charming instructor, even if you've never seen me before. Those are my assumptions. If you have otherwise, let me know, but that's what I'm working with. And it's quiet right now, so I just wanted to thank everybody. What are we thinking about here? Okay, so I have the window before earnings. I have the earnings themselves. Sorry, that's a little off. And then I have the window after earnings. And the biggest consistency in the expectations that we have with what's going to happen. If you're just trading stock, there's really nothing here for you other than watch out for gaps, right? The probability of a gap is going to increase significantly when you get around the earnings. So we're thinking that we're going to have implied volatility go up, maybe pause up in here, and then pop back down. Okay. So what does that mean for me? That means that going into the strategy, I am thinking I want Vega positive. So Vega is the Greek that represents how we expect our options to behave based on the dynamic of implied volatility. So if I'm Vega positive, that means I want implied volatility to rise. I'm going to rise up. Okay. If I am Vega negative, I want the implied volatility to drop. So if I'm thinking of getting in before earnings, then at this point, I'm thinking to myself, Vega negative. Then after the implied volatility has popped, whatever I think is going to happen next from this point forward, typically I'm going to find the volatility low so I can look back at another Vega positive strategy. Does it always happen this way? Of course not. Is this a strong enough tendency that we want to incorporate it into what we're doing? Yes. Yes. So what kind of strategies? If I'm looking for Vega positive, I'm looking for a buying an option, buy a call, buy a put. You buy a call, volatility goes up, it pumps value into your call. I'm thinking an out of the money debit spread, right? Very, very similar, but an out of the money debit spread. I'm thinking maybe even a calendar spread. Those are all Vega positive. Vega negative. If I'm going to be directional, I'm going to do probably a credit spread through earnings. So if I'm bullish, I would be doing a bull put spread. If I'm bearish, I would be doing a bear call spread. And if I think that the expectations are overblown, I would do a naked strangle, which is selling an out of the money call and an out of the money put, or to lower the margin requirement, an iron condor. So if you watch Vlad or me trade, you will see both of us do different variations of iron condors, where what we're saying is everybody thinks something's going to happen, so I'm going to come in thinking it's not. It's going to stay in a range. I'm trying to think. Does anyone remember the last? We just did one not long ago. What was that stock we just did? If anyone remembers, we put it on, I think on a Thursday, just a couple of days. So again, when you think earnings cycle, this is the cycle that we're thinking about. We're thinking about pre-earnings, 7 to 10 days, maybe 2 weeks before, the earnings announcement, and then typically the trade we build. That whole window is not really what I'm looking for. I'm thinking about the first 3 to 5 days after, when whatever happens and the implied volatility is low, and then it can start to build again. So if I put a trade on here in this window right after earnings, what am I thinking about? I'm thinking about something with low volatility and starting to rise again. Can you catch the value of Vega buying a credit spread instead of buying? So Roderick, if you're going to sell the volatility for the crush, that's when you would do a credit spread. How far before earnings do you buy the call or put on a bull put spread when Vega positive? So it would be buy a call or buy an out of the money bull call spread, and you're thinking 7 to 10 days ish. We actually did one recently on Facebook right before earnings. So here was earnings, and we came in right at this junction right here, right? The trend was still up. It had pulled back and turned. We had a nice directional signal, and I thought, I've got plenty of time. So I buy an option, and you can see the volatility did finally catch a little bit, but it didn't go up too much. I mean, it was a more gradual climb, but like I said, stay high or increase. And that's exactly what happened. So we got in, rode it up for 3 days. I think I got out halfway up this day. It kept going a little more before earnings. Then what? Then got out, right? We got out of that. So if you're just going to be a little speculative before, what are you taking advantage of? You're taking advantage of the most consistent time for implied volatility. You're not worried at all about implied volatility or time. So in this situation here, this was the window for getting out. We got out. What happened? There's the crush. Volatility dropped from 35 to about 27. Now it's down here. It's a little bit lower. It's not all the way down to this low, but it's pretty low right now. And it looks like this thing is about to give me another signal. So now I'm in that third. So there's pre-earnings. We did a pre-earnings trade here. We did not do an iron condor. We could have, but we didn't. We thought about it. I think I even built a little bit of it, but we didn't do it. So we took let's just real quickly and informally put it into earnings cycle stages. So stage 1, pre-earnings, 7 to 10 days, maybe even upwards of 2 weeks. What do we expect? We expect volatility to be rising. There can be price movement. I'm going to go with the overwhelming trend like we did here. So we took advantage of this window here. Great. That's stage 1. Stage 2 is right here. Earnings. We did not do anything with earnings. It gapped down, but not that much. So the iron condor, anyone do one out of curiosity? If you did an iron condor for the last couple of days of that week, you would have been just fine and made some money. But now what's happened? The sellers have come in, not a lot of volume. My stochastics is getting down here where it's oversold, and I'm thinking it might turn up, and this might turn into the trend. So now I'm thinking I'm in stage 3 of the earnings cycle, which is the post-earnings trade. What do I have? I have volatility down, and I have a potential setup then for the next trade. So this is a number 3, post-earnings opportunity. Prior, over, after. Prior to earnings, holding through earnings, and then what trade might set up after earnings. At this point, if I get a signal, I think I looked at Facebook on the model. Yeah, so there you go, right? What do we have? We have the model showing this bullishness coming out. We have this trend in place. Communication services been pretty strong. Everything we're looking for, and what do we know? We're right after earnings, so we would expect the volatility to have bled off. I mean, it's not the lowest. Like I said, it did get a little lower right here for a little bit, but other than this little dip for a couple of days, this mid to upper 20s is actually pretty good. For the second stage for Facebook, what would be the strategy? Bear credit spread? Actually, I probably wouldn't have had a directional bias. If you were directionally biased bearishly, you would do a bear call spread. If you were directionally biased bullishly, you would do a bull put spread. If you did a bear call, would have worked out great the day before because the stock dropped, time passed. So a bear call spread is a delta negative trade. You want it to drop. It's a theta positive trade. You want time to tick. Well, in this case, it was only a day or two, but it still helped. But the stock did drop, and a bear call spread is vega negative. So we want volatility to drop. Well, the volatility dropped from approximately 36 to approximately 27. So about 8 or 9 points overnight. That's a nice little catch. If you did a bull put spread, you want the stock to go up. It didn't. That would have hurt you, but the time and the volatility would have helped you. I would have done an iron condor, which if you're not familiar with that strategy, an iron condor is a combination of a bull put spread on the bottom and a bear call spread on the top. So if it was a stage 2 trade, then I might have said, let's put a bear call up here at 390 and a bull put down here at 340. And then if it stays anywhere in between, we're okay. And I'm looking to try to just get a little bit of a credit, you know, maybe $2 to $5 wide spread on this side. And then maybe a 2 to 5, well, the exact same on this side. Then I would be looking to, now I probably would have done Friday expiration. So this was Wednesday, and then I would have had to have held Thursday and then Friday, and then at Friday, boom, it's over. It expires worthless. So whatever credit I collected, I would keep all of it. Or I could probably have got 70 to 80% of it even on the first day if I didn't want to put it at risk. So that's, you know, when you're holding through earnings, you have to know that volatility will drop, period. It's going to drop. It's going to drop on both sides, calls and puts, right? So a lot of times you'll notice that I've talked about buying directional calls before. I've talked about selling credit spreads or selling options the day before to hold through. There is another strategy for holding through earnings, and it's just a straddle or a strangle. That's where you're buying a call and a put. But the thing is I don't want to buy expensive calls and puts to watch them both. I've done it, right? I've done it. I've bought a call or a put. Stock went up $2. The puts were worthless. The calls dropped 50%, even though the stock was up $2. Why? Because if they price in a $5 move and we get a $2 move, those options are still going to drop. So, more frequently than not, we're looking for them to have been overpriced on the expectations for earnings relative to what actually happens. So if I had done a stage 2 iron condor, I would have just done a couple of days. Now I have done where I do 40 or 50 days, and I'm just looking for a quick hit in vol, and I shut it down and I take some profit and go. Or I get a bigger credit to start with, which gives me a little more protection if things go wrong. But in this situation, we didn't end up doing it. But this is setting up now for a stage 3 post earnings trade. Volatility is down and stayed down. So, if we wanted to be a little more speculative and buy some cheap out of the money calls when this thing turns, you could do phenomenally well with that type of strategy. Question came in. What are your thoughts about the strategy of selling an iron condor one day before and buying back the following day? Yeah, that's exactly what I'm talking about, Cecil. Yeah, exactly, right? And not necessarily, I sell it the day before. So like I said, when I'm selling an iron condor the day before, I can sell just like the next Friday. If it doesn't have the next Friday, I don't want to do it. I don't want to sell an iron condor on something that doesn't trade weekly options. That's something I would just want to throw out there. If it doesn't have weekly options, I'm not interested in doing it because it just doesn't have what I need for liquidity, for the ability to get in and out of that trade. Okay. But when you do that iron condor, you can go for the next Friday. So that was on a Wednesday. It would have been a 2-day trade, right? 2 days. Or I could go further out in time, which gives me a little bit more protection. And I'm not looking to hold it until expiration. I'm looking for 2 or 3 days to pass, 2 or 3 days of volatility to suck out, and then I would look to put it on. So I like that strategy quite a bit. So does Vlad. With iron condor, you catch time decay and Vega, Roderick asked, and the answer is yes. We will be theta positive. It won't be a ton of theta. I mean, if it's only a few days left in the week, it'll be pretty good theta. And so you'll get a couple of days of theta. That'll help make money. You'll get a good swell of volatility dropping on both sides. Both sides will benefit from the volatility dropping. So as long as the price move, and for me, I'm usually looking like 5 to 6%, sometimes 7. As long as it doesn't move. So if you ever have a trade that moves like 8 to 10%, yeah, that's tough, right? You're gonna get a little bit punched in the mouth on an iron condor, and you'll have to say, okay, now how do I want to manage my way out of this? So you do have to be careful with that. Is an iron condor a better strategy than a butterfly? In this case, it is, because you're trying to just give it a range. A butterfly, for anyone who's not familiar, is a very similar option strategy. It's also a delta neutral, meaning we want it to stay basically where it is. Vega negative, theta positive strategy. So it would make a butterfly would make money from volatility dropping. A butterfly would make money from time decay, but a butterfly is not going to give you the range, right? A butterfly. I love the questions. Love the questions. I hope everybody feels like this is making sense. Butterfly looks like this, right? And then we have our break-even line somewhere down here. Ignore that one eyebrow line. That's wrong. And we want it to stay between this and this. An iron condor, very similar, is like this. Right? So it's basically like you're taking the butterfly and you're stretching it this way and stretching it this way, and you're flattening the top, and it gives you this plateau structure. So now, as long as it stays above here or below here, so it's going to give you a higher probability of success, a higher probability that it does stay inside of the range that you're looking for. They are both delta neutral, especially if you start somewhere near the middle. They are both theta positive. They will make money from time decay. They are both Vega negative. They will both benefit from volatility dropping. So in that regard, they are very similar. I hope that answers your question. More profit if you pin it. Yeah, if you can pin it. But if you can pin it, you may as well try to trade directionally, right? Do you use delta as a guide for the short? You can. So if you're picking these strike prices out here and out here, I hope when I say out here, you see where I'm drawing my lines. A lot of times people will sell a delta of 0.15, which is there's a 15% chance of it being in the money with a delta of 0.15. Loosely, theoretically, that's what it means. Loosely, theoretically, the delta can be used as a probability factor to say what option is likely to bring me the most amount of credit while at the same time giving me the highest probability of success. And you are definitely looking to go out of the money. Personally, do I like butterfly or iron condor? Both. If I'm trading for earnings, I like iron condor. I absolutely will slap butterflies on neutrally after a swell in volatility. Yeah, I like butterflies. I think because the thing about a butterfly is it can be adjusted. The problem is I don't have time to adjust it. By the time I can adjust it with earnings, the price has already moved. But if I start with a butterfly on just a normal stock or an ETF, and then the stock moves up or down, I can add a second butterfly up or a second butterfly down. So in that regard, I prefer the flexibility of a butterfly, so I can wait to see which way it goes before I put the second piece on. With earnings, I need to have the width in order to have the probability in my favor. Whew, man, we're cooking today. No slides, and yet we're flying. Okay, so let's just stop for a second and just check in. My pleasure. I appreciate the questions. If you're thinking it, someone else probably is too, right? It's just a matter of saying, number one, do I need to consider an earnings-based strategy, right? Where's another one? Let's look at Penn. Penn National Gaming is actually one we've traded before. Yeah, it's not really recovering much there. What else do we have? Yeti is that's a retail type stock that's been okay recent. Oh, look at Yeti. Okay. And you can see the vol now on Yeti. The vol has come down just a little bit. I would actually think this turns back up for the next couple of days. These are going to be released on 8/5 before market open, right? Before market open. So that's Yeti. What else do we have that's coming out here? Kellogg, Papa John's Pizza. Okay, let me take a look at Friday. Everything's after or before the market on Friday. DraftKings. Oh, there's some pot stocks. DKNG is reporting. You can see DKNG the last time it spiked up and crashed down pretty hard and fast. You could see the same kind of a thing here. CGC, pot stock, they've got earnings. This one has definitely swelled a little bit. It's only an $18 stock, but that would be maybe one to consider. There's a lot of vol here. Kronos, I don't think they have as good of options, but they're a pretty similar looking. What else do we have? Floor. Yeah, okay. GM, Osama said. Okay, yeah, GM, there you go. GM is unspecified. I don't know, what does that mean? Let's see what Earnings Whispers has to say. General Motors, they had strong first quarter results. That was back in May. And you can see it popped a little bit, then sold off, then popped. If you have time, can you give an example of an adjustment of a butterfly? Yeah, I will try to. It's a little outside of what we're doing with earnings, but I could probably spend a quick minute jumping in there. What do we see in here? It's really not. I'm not really seeing much for General Motors. Got a Yeti 90, 95, 50 call. Is that a bull call or a You bought that going into it? Yeti. Let's go look. Yeah, I mean, it's a very bullish looking stock. I think a bull call, if you're directional, then a bull call going into it is the right way to go. If the stock does have a bad report and it drops, that will hurt you, but the volatility will also drop, which will help you. And depending on where you are relative to the spread, you said 90, 95. Yeah, so I would imagine you're in a positive time decay scenario right now. As long as it doesn't drop too far below your short strike, you should stay theta positive. So if it were to drop a little bit and just sit around like 98, 97, that would be reasonable. So I mean, you can see last earnings, it started flat and then moved up. The prior earnings, it gapped down and then continued a little bit down. So yeah, that's the hard thing, right? The direction's a bit of a crapshoot, but we do know time is going to pass and we do know volatility is going to drop. So that's where we're trying to integrate those things. Yeah, let's take a quick look. I mean, I feel like I've covered it. If you feel like there's any lingering earnings questions, there's no magic strategy. Here's the last thing I'll tell you. I'm going to just kind of wrap up the earnings discussion. The market makers that are, on the floor of the SIBO, they didn't fall off a turnip truck on their way to the exchange and decide, hey, maybe I'll go be a market maker, right? They are savvy. They are experts at pricing options. So as implied, as volume is going up and down, coming into earnings, they know what we're trying to do. There's no secrets. There's no like, ooh, I'm going to pull one past them. You're not trying to, right? We don't try to outsmart market makers in the same way that we don't try to outsmart the market. You don't outsmart the market. The market's always right. You don't outsmart market makers. You just listen to what they're asking for and understand that whatever it is they're asking for will have an advantage. If they're asking for buyers, they're doing it by making options cheap. If they're asking for sellers, they're doing it by making options expensive. They're the ones who control and dictate option pricing based on supply and demand. You're just using the visual representation that implied volatility offers to understand that dynamic better. Are they looking for buyers or are they looking for sellers? They know people are buying going into earnings, so they're raising the price. They know that everybody who bought going into earnings is going to sell when earnings are done. So that's the crush. They don't open the market and say, oh, are people selling? Are they? I guess maybe they are. Let's start lowering the volatility. They're like, okay, we're going to open this thing and there's going to be a preponderance of selling. So we're going to preemptively lower that. That's the crush. That's where the volatility disappears. So on Iron Condor, one day before earnings, what is your guideline for amount of credit received? Do you use credit as a goal? No, I mean, I don't necessarily. That's probably something I should have, Cecil. I mean, I'm a little embarrassed that I'm really just kind of building it wide enough. I'm more interested in getting the price action wide and then just kind of looking at it and saying it looks pretty good. God, I don't know, maybe 25% based on the width of it. So if it's $2 wide, I'd want at least maybe like 60 to 70 cents. If it's $5 wide, I would want at least like $1.25. That sounds reasonable in my mind as I say it. The amount of time is obviously going to have an impact. So yes. I hope that helps. I'm more interested in the width of the condor necessarily more than a credit as a percentage of the spread. But I do think that 20 to 25% as I play with it in my mind, that seems reasonable for both sides. I'm gonna have to make a note and maybe pay a little more attention to that going forward. It's August 20th option, so I need to decide to hold or sell to close before earnings. Yeah, I mean, it's got some protection if things go wrong. if that helps to hold through it. But I agree. I mean, I don't usually hold through earnings unless I specifically intended to hold. So the AMD was a specific speculative trade holding through earnings. Iron condors are specifically taken to hold through earnings. Facebook, I shut it down. I'm out, right? And now I can look to get back in. So there you go. Okay, let's take a quick look at an iron or a butterfly. Okay, so let's say that I put a butterfly on. I'm gonna go out to September for this butterfly. And I'm gonna go maybe a little above where we are now. I'm having a lot of fun today. I just want you guys to know. I hope you're enjoying it. It's good discussions. Let's go about 8 points wide. Let's go 434 on one side. Let's go 450 on the other. There's my butterfly. What does this give me? It gives me a nice broad range. You can see here I am delta negative, I am theta positive, and I am vega negative. Like I said, right? What do I want? I want it to go down a little. You can tell that because this purple line has just a little slant. I can actually make money out here, even to the outside of my triangle. Okay, that makes sense. I like that. God, I look at this and I think I almost should have put this on for what I expect the market to do the rest of this summer. I'll be looking at this tomorrow. So the person who said, do I like these? I do, absolutely. Look what it gives us, right? Not a lot of risk, plenty of upside potential. Then if the stock were to drop, remember that if the stock is dropping, volatility is rising. And if the volatility rises and the next butterfly I put on would actually be even better. So let's just say, for example, that in this scenario, the stock dropped down here to 431. I'm actually making a little bit of money, but I'm thinking this thing's going to stay and come back up. It might sit where it is. I could actually add a second butterfly. I'm going to take this down to 430 in the middle. Then I'm going to go 422 on one side, 438 on the other side. And now I have there. Now it would look something like this. So this doesn't look like an iron condor, right? Remember what I said, an iron condor looks like this. Up, steady, down. But it gives me the same basic components, right? That I have a range between, down here at 424 and up here at 447, that if it stays in this range, what happens? As time ticks, tick, 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 I make money. I have plenty of upside potential. This thing could even pop up into this range here. So that is a neutral, delta neutral. I mean, there is some delta to it, but it's mostly a stay in a range, make money from time type of a trade. Who asked that question? Somebody asked. I thought somebody asked, how would I add a second trade? So the thing about this is, if this were to move to the other side, I could add maybe a butterfly, maybe a calendar to the other side. And that would kind of just, extend the range of the trade. There it is. There it is. So we got a little bit of Greeks today, functional Greeks. I hope that made sense. Talked about some different strategies. Some were directional, some were non-directional. Some were looking for volatility to increase, some were looking for volatility to decrease. Hopefully you can see the flexibility that options provides us. I'm an options guy, and this is why. Man, I love options. If you don't speak the Greeks, learn it, learn, because I'm sure there were some of you out there who are like, Vega, what? Positive, negative? I remember early in my trading, I'm like, what do you mean? Delta neutral, delta bot, right? The Greeks help us understand how will our trades behave. The sign of the Greeks helps us understand what we want. So delta tells us if it goes up or down. Delta positive means we want it to go up. Delta negative means we want it to go down. Theta tells us how will it behave relative to time. Theta negative means I want time to tick backwards. Unfortunately, that never happens. So if you buy an option, you're theta negative. It's going to hurt you. You just need to know by how much. Theta positive means it's helping me. By how much? These are theta positive trades. I make money every day. Vega helps me understand how will my trade behave based on changes in implied volatility. Vega positive, I want volatility to rise. Vega negative, I want volatility to drop. The Greeks should be very functional. They shouldn't be a mystery. So there it is. Should you go 1 month ahead with Butterfly? I mean, it's not really a should. I mean, this will be easier to control, easier to contain, but the money will come slower. If I change this to August, the theta will speed up considerably. But I make less money. So you can see this thing starts to crank up there faster, but my range is a little less. Oh, maybe I would consider this a possibility for August. That's not a terrible proposition. You get to where, I mean, look at this. By the end of August, you're making a couple $100 a day in time, right? That last week. So it's like, can I put this on and manage it until it gets to that point? And then I have this nice range bound trade. I love trade. We've done phenomenally well in our trading room. We've done butterflies and calendars. I think we've done at least 7 or 8, maybe even close to 10 of them since the summer. And we have only been wrong on one calendar spread we had to close, one. So I love neutral trades, and neutral trades is what sets options apart. You can't make money on stocks if it goes sideways. You can't make money on futures or currencies if it goes sideways. Options, I can make money if it goes sideways. And right now, as I look at the cyclical representation and projection for the market, I'm a little bit worried about sideways. I think that's definitely something that could be happening. So, okay, wonderful questions, wonderful participation. I have a couple minutes. Are there any lingering questions before we go and shut her down and let you get your afternoon coffee? Or maybe it's evening cocktail where you are now. Still afternoon coffee for me. Any other questions before we call it? So earnings cycle. Remember some of those key points. Know when earnings cycle is. Know when that 3-week window is. Make sure you have a mechanism so that the stocks on your watch list, you know exactly when they're going to repeat earnings or report earnings. Know what the expectations and the pattern of history is. Would I buy AMD now? No, it's way too late for me now. At this point, you're chasing. Look at, I mean, you're just chasing that, right? That's bigger than it's moved all year. It's hard to have expectations it's going to continue. How far out would I recommend butterflies? You know, anywhere from 3 to 6 weeks, quite honestly, for me personally. What kind of trading should someone look to do after earnings? After earnings, I'm going to typically, if there was a strong trend, I'm going to look for it to continue trending. If there wasn't a trend, then maybe you would look for sideways. But for me, I tend to do most of my neutral trading on the indices, SPY, DIA, IWM, QQQ. I don't tend to do a lot of neutral trades on individual stocks. I would rather trade the market neutral and then find momentum in the individual stocks. So I'm looking for something like Facebook that coming out of earnings, it's still in its prior trend, and I'm looking to be directional with it. God, such good questions. Very good questions. Very appreciative. I really appreciate everybody's participation level today. It makes it go so much better when I can feel like I'm interacting with you rather than speaking at you. So I appreciate that. I hope you will, if you're in the trading rooms, I am filling in for Vlad tomorrow morning, Thursday morning. So I'll be here everything but the last session on Friday. So join me for that if you can, and have some morning coffee with me. If you are just checking out Tradespoon, you haven't joined, join. Don't hesitate. It's a great value, one of the best I've seen in trading education. I've been in the industry a long time. A lot of good indicators and tools, a lot of good insight from traders who have been here and doing this for a long time. So if you're thinking about it, stop thinking, jump in. And for those of you who are already subscribers, of course, you know we love you, and I'll look to see you soon. If nothing else, a couple of weeks from now, we'll do another one of these. Thanks for coming out, spending your afternoon with me. I very much appreciate it. And espresso tomorrow morning, Faust? Absolutely. And it's always a double. Have a great rest of your day. And as always, my friends, happy trading.